Let's get across the market open now. Mark Gardner joining us from MPC Markets. Mark, welcome. Let's begin on Wall Street on Friday. Third quarter earnings season kicking off with the big banks.
Yeah, JPMorgan, Wells Fargo, amongst others, but all very positive so far. Up anywhere from sort of 4 to 6% for most of those banks. Private wealth doing well, I think, for JPMorgan. So obviously we had a bit of a lift there, and we've got Morgan Stanley, Goldman Sachs this week as well. I think Tuesday and then Wednesday. Some of the big healthcare companies, Procter & Gamble on Friday, United Health on Tuesday as well. So Netflix as well on Thursday. So we're and obviously we've got ECB on Thursday with our employment numbers as well. So and then a couple of Fed speakers lit it over the course of the week. So but news over the weekend obviously was the China stimulus announcement, which may or may not be taken well by traders, just due to the fact that whilst it was they definitely covered the low end with the biggest bond issuance since 2007, 2008. They weren't particularly specific, but it looks like they're going to start to nationalise some of those sort of regional council area debts, which will help them out, and obviously some property and low income earner targeted stimulus as well.
Do you think that's likely to disappoint? Because there's a lot of expectations built into what we're hearing from China. They didn't really come up with anything new on Saturday. They are having another press conference today, in fact, so it'll be interesting to see what they have to say. That obviously also comes off. Yesterday we got CPI, that was up 0.4% year on year in China. Goldman Sachs also out now believing that it will achieve its 24 growth target of around 5%.
Yeah, that was interesting that Goldman Sachs came out with that. I think that gives some confidence that China said they were going to hit their targets, and the market wasn't particularly happy with that. They wanted the bazooka, which is kind of the most overused word at the moment in terms of all this stimulus, but it was expected between 2 trillion and 10 trillion yuan, and they got the 2.3 as an absolute minimum. So it's definitely covered the low side. Obviously, there'll just be more details come along, helping out this property and local government sectors with some extra bond issuance as well. But I think that it's probably it's looking fairly sensible. It's looking like it's targeting the right areas, and I think Goldman's is probably bang on that. It will help them, it will help them hit their targets. So while the traders might be disappointed there's not an absolute flood, I mean, there still may be. It's just they're not, they're not coming out all guns blazing straight away.
What are you seeing in equity markets at the moment, Mark, given that we're at record highs pretty much across the board at the moment? You look in the States, locally, China, of course, going gangbusters. And that sort of goes against, I guess, seasonality, what we tend to see this time of year.
Yeah, absolutely. Seasonality is usually fairly negative around this part of the year, particularly in an election year as well. So it just seems to me that the market's on hold until this election's out of the way, because we've thrown 2 hurricanes, Middle East conflict, a jumbo-sized rate cut, all sorts of different things at the market so far, and it just seems to be able to grind higher, which means it just gives me the impression that the market's fairly neutral until this election's out of the way, and realistically, there is, I think, some concerns over inflation now with those hurricanes, and particularly that print for inflation last week, obviously, which doesn't take into account the hurricanes. However, it could start to see a bit of a stagflationary effect because we'll see rising prices and obviously rising job losses. So, the Fed's job's not over yet. Just when they thought they had it under control, nature threw 2 hurricanes at them. So, I still think everyone's a little bit on the fence, and that's probably reflective of how we're just grinding higher. We're not spiking higher.
So locally, what are you doing at the moment, Mark?
We're pretty happy with those mining stocks, particularly the buying when it was going to be economic Armageddon. We're being relatively agile, staying out of those highly cyclical names in consumer discretionary as it stands, but there's still some bargains around, there's still some good small caps around. We, as I said, stay agile, and if things start to turn sour in the US economy, or there is a sharp move and the market picks a direction after the November 4 election, then we'll probably react to that when the time comes. But at the moment, we're sort of pretty happy being in a small amount of cash and making sure that we're in really high conviction trades rather than anything that's marginal.
All right, because I mean, obviously the miners have been the big movers.
Yeah.
So are you happy to play that trade still?
Yeah, absolutely. I mean, we would probably be trimming some of the miners back towards those highs from last week. But we had the advantage that we added to them a little bit lower and didn't start buying in until, so around the 20 mark in Fortescue or the 40 mark in BHP. So, but that's more just taking a little bit of risk off the table and managing those positions. But yeah, I think overall we'll be pretty happy to take those little wins off and return to cash and not be sitting there just with a full portfolio which is at the whim of the market when there's so much going on in the background.
How are you feeling about the lithium miners at the moment? Because sort of this time last week it was all about Rio and Arcadium, which really put a bit of a fire under the whole sector, didn't it? So should we get enthused by that, or do you think that's a little overdone?
I think the statement from Rio that said we can't start this cheaper, than what we're paying, I think does put a long-term floor in those lithium miners. Whether they start to rocket higher, I doubt that very much so. However, those high-quality lithium miners with long mine lives and and that low production cost, like say Liontown, which has just come into production this year, 26-odd year mine life, has been the subject of M&A activity in the past. Looks extraordinarily cheap here, under $1. And then you probably just go to your fairly traditional MinRes or PLS, but with MinRes, very, very volatile trade, and you probably missed the boat a little bit now. If you weren't buying under 40, I don't think it's the smartest of ideas to be buying here at the moment, but I think there is some decent value in that Liontown.
And Mark, some news out this morning, TPG selling its fibre and fixed assets to Vocus for $3.5 billion. Oh, well, it's US. What, five and a quarter?
Yeah, about $5.25 billion.
Yeah.
I think they'll net about 4.7. I didn't get across a huge amount of the detail on this because it just came out as we walked in studio. But I think it's roughly about 10 times revenue or 10 times earnings. So it's not a bad price for. I think Macquarie and Aware Super have got a portion of that as well. So it'd be interesting to see how the market takes it. But it's obviously at 10 times. It's not a bad price, but I haven't had a chance to dig really deep into the detail yet.